Hi, thanks for joining the presentation today, where we're introducing the YCharts value score and the 10% sector report. My name is Eric Kobayashi Solomon. I'm the Director of Research here at YCharts. None of what I am going to present to you today should be construed as an offer to buy or sell securities. For our agenda, first we want to say what the value score is, and then take a look at some of the value score backtesting results. And then last, take a look at the YCharts 10% sector report, which uses the value score framework for screening. What is the value score? Well, the value score is a quantitative model, uses 6 factors, and rates each company based on objective criteria relative to all the other stocks in the YCharts universe. Here's an example. This is the factor score, or the factor chart for ExxonMobil. The 6 factors are earnings yield, operating earnings yield, free cash flow yield, book to market, dividend yield, and price to sales. Now these radar charts are a little difficult to read at first, but basically when a value is high, it will be further from the center of this chart. And so you can see that ExxonMobil's values are all very high, or mostly very high. So the area covered is pretty large in this 6-figured object. We can compare that to the value score factor chart for Amazon.com. Here you can see that on each of the measures that we're taking a look at for the value score, Amazon scores worse. So it's not screening as attractive on a valuation basis looking at our criteria. Now, any quantitative model has various strengths and weaknesses. There's no way to get around either of them, but we should understand what the strengths and weaknesses are. Let's take a look first at the strengths. Obviously, the factors that we're using highlight companies with strong, high-quality earnings. All of these factors have been discussed and studied in rigorous academic and practitioner research. And as you'll see in a moment, the backtesting results are really incredible. Now, for all these strengths, it does have weaknesses as well. One of these is that it discriminates against non-dividend paying stocks. We're using dividend yield as one of the factors, so a company that doesn't pay dividends doesn't score as well. Also discriminates against asset-light businesses because we're using a book-to-market ratio. Now, just because a company doesn't pay a dividend or it's an asset-light business does not necessarily mean that it won't score well on the value score in the value score matrix. However, it means that these kinds of businesses simply have to score higher on each of the other 5 factors. Now the last weakness, and this is a bit counterintuitive, but it actually discriminates against companies with high gross margins. And this is due to the inclusion of price to sales, which tends to be higher for high gross margin firms. Let's give an example of this. We have 2 companies, Oracle and SanDisk. They're both high-tech firms. Oracle is a software maker. SanDisk is a maker of NAND flash drives. And you can see that the software maker has a much higher gross margin, nearly 82%. And the hardware maker has a lower one, around 50%. You can see that this gross margin is reflected in the center column, where the price to sales ratio is much higher, not quite double, for Oracle than it is for SanDisk. However, if we look one more column over, we can see that the PE ratio for both of these firms is just about the same. So it's not as though the price to sales ratio tells the whole story about either of these firms. like the other weaknesses that the value score framework has, if a company has very high gross margins, it just simply has to score better on other of the factors in order to get a high overall value score. Now, the value scores are grouped into 10 equally sized deciles. And these deciles, these scores, are recalculated daily. You can go onto the YCharts site and see that the values do change from one day to the next, especially if there's a large price movement or if the company has just issued financial statements or something. And every stock within the YCharts universe that meets certain criteria is assigned a rating. Now, how do we visualize these value score deciles? This is what I think of when I think of the value score. 10 equally sized boxes. Usually there are about 4,200 rateable stocks in the universe, and so each one of those would have a tenth of the number of stocks, about 420. Now, the VS10 stocks are the most undervalued ones. In other words, these are the ones that screen the most undervalued vis-a-vis our 6-factor model. And value score 1 stocks are conversely the most overvalued. Now that we understand kind of how the value score is set up, let's take a look at how the value score has performed in the past. So from an investment perspective, it's the extreme ends, the value score 10 and the value score 1 groups, that are the most interesting. And so these are the two groups that I focused on when I did the backtesting. As a comparison, I have used the S&P 500. Here we can see the charts for 3 groups. The blue line is the value score 10, the orange line is the value score 1, and the gray line is the S&P 500. The backtests were conducted over a period of about 34 years. We started with a value of 100 at the end of December of 1979, and then went all the way up through, I believe it was November of 2013. Now, this chart is on a logarithmic scale on the right or on the left, so we can get everything in. So you'll see that these, each of the lines kind of go straight up. If we didn't put it on a logarithmic scale, then it would have been very hard to make sense of this chart at all. Now, one thing that I'd like you to note is that one of the main ways that we think about risk for a security is through its volatility, its movement up and down. Take a look at these standard size bands. You can see that the VS10 series hardly moves outside of that fairly narrow band during the entire 34-year period. You can see in contrast that the VS1 group does move, in fact, significantly outside of that band, even for significant amounts of time. S&P 500 is straighter and less volatile, but certainly you can still see volatility there. Another thing to note is the ending value for each of these series. The VS10 series, starting with a value of 100, ends with a value of nearly 138,000. The S&P 500 ends at a value of about 2,400, and the VS1 group ends with a value just at 97, just around 100. So as I took a look at these charts, it looked very interesting, and the first thing that I wanted to take a look at was this concept of risk and volatility. And the return stability of the VS10 group should show up in each of the group's risk and return measures, I thought. So I took a look at the average monthly return, the maximum return, and the minimum return for each of the groups. First thing to note is that the VS10 average return is better than either of the other two. The value score 10 maximum return is well higher than the S&P 500. It's less than the VS1, but this is just a measure of the volatility. We can see that since VS10's average return is much better than the VS1's average return, that even though it had a higher max return, that really didn't help the group overall. And then the minimum return for the VS10 group is less negative than either the S&P 500, which is all the way to the right, and the VS1 group, which is right in the center. Another way to look at this is by looking at big wins and losses. So here I've charted any wins of greater than 5% in a month as the green side, and then any losses of greater than 5% per month on the red side. You can see that the VS10 is skewed strongly towards the wins. It has a much larger green section than it does a red section. The VS1 is more evenly balanced, and S&P 500, while it's still skewed, it's skewed a lot less notably than the VS10 group is, and it's also got a lot less large wins. After looking at this, I thought that probably these monthly risk and return profile should translate into a consistent picture over longer time periods. Because most people are interested in annualized returns, that's the next thing that I looked at. I split up the annualized returns into 3 decades, the 1980s, the 1990s, and then the 2000s on. These green columns represent the annual compound return during that decade. And you'll notice that the VS10 group is really consistent in terms of annual compound return. It's generating over 20% compound return in each of these decades. It doesn't change much at all from one decade to the other. That stability is a very good sign. Now, on the flip side, we notice that this VS10 annualized return in the 80s was actually negative. The S&P 500 returned nearly as well as the VS10 group did in the 1990s, but of course the 1990s ended on a high note, and the tech bust in the 2000s took a lot of those gains away, whereas the VS10 group was consistent every decade. Now, these red bars represent maximum drawdown. This maximum drawdown that's pretty large back in the 1980s represents the returns around the Black Monday event in 1987. Other than that, though, you can see that the maximum drawdowns for the VS10 group were pretty consistent. Now let's dig into the backtests a little bit. We know that over the long term, the value score works really well. This is exactly the kind of chart that we'd like to see. However, there are some times during this series that it seems like the S&P 500 or maybe the VS1 group is actually outperforming the VS10 group. So I started thinking that perhaps the phenomenal results would change depending on when we chose to start the experiment. So I wanted to try to check for this kind of effect by looking at consistent underperformance of the VS10 group, or generally by looking at periods in which the relative performance between any of the groups was somehow wrong. That, for instance, VS1's returns were less than or VS1 returns were higher than VS10 or something like that. Here's how I did that. I took a look at each of the months where the S&P outperformed the VS10. And I just made a vertical blue line there. You can see that there are some vertical blue lines that are thicker than others. These are months where the S&P outperformed the VS10 for subsequent months. In other words, one month right after the other. Now, kind of looking at this with squinted eyes, it looked to me like there were three distinct areas that I needed to focus on. That middle area right there in the 90s is particularly glaring, but then the late 80s also don't look good. And kind of the 2000s also have some large areas of blue. However, I started to think that, it's not really the monthly returns that are important, but if there's consistent underperformance of the VS10 versus the S&P 500. So I simplified the graph a little bit and asked for months where there were 2 or more consecutive months with the S&P outperforming the VS10. And sure enough, I still have these same basic 3 groups. I also did the same kind of checking with the VS1, but because I knew it was more volatile, I just looked at 3 months of consecutive kind of abnormal returns, and I found generally the same kind of trouble areas. So I decided to take a look at each of these separate areas, and I've nicknamed them according to the time period. The 80s was the Age of Gordon Gekko. The 90s was the Age of Irrational Exuberance, and the 2000s the Age of Easy Money. Let's take a look at each of these periods in turn. So in the 80s, things were not looking good for the VS10 group. You can see in this entire presentation I've colored the VS10 group in blue, and the blue line is underperforming starting at about 1986, fall of 1986. It's underperforming for a few months, both the S&P 500 and the VS1. We even see early on in this series a time when the VS1 crosses over the VS10. Well, what happens after this? In fact, this is the Black Monday event of 1987. You can see right away that the VS1 group fell much more heavily. S&P 500 did not fall as much as the VS10, but as we came out of that period, the VS10 gradually overtook the S&P 500 and then pulled away from it in terms of performance. So this told me that even if we started in kind of late 1980s, this portfolio still would have performed better than alternatives. Let's look now at the Age of Irrational Exuberance in the 1990s. Of course, this period of abnormal returns was the most striking, and so I wanted to take the closest look at this. This is what the graph looked like from about October of 1993 all the way through October of 2001. You can see that the blue line representing VS10 and the S&P 500 gray line are hugging pretty close to one another for most of that time. Now, you might say, well, this is not great performance if it's hugging the S&P 500 so carefully, but you should also note that it's more than doubled in the time period just through the end of 93 to 1998. So this is not bad overall returns. And when I started thinking about why these returns would be so close, I was looking through a lot of data, and I found that the number of listed companies really jumped hugely by about a third during this time period. So my hypothesis is that this kind of new emphasis on equity culture and all the IPOs and kind of excitement about ownership of equities had something to do with this abnormal period of performance. Now, just to give you an idea of the time frame that we're talking about, this is when Amazon IPO'd. And this downturn here is the Asian currency crisis and the LTCM crisis. Now, if you recall, Wall Street banks, supported by the Federal Reserve, bailed out this big hedge fund, LTCM. And right after it did that, the market just took off. People are always excited, investors are always excited when it looks like the government is going to write a put option on their equity positions. So you can see that at this point, the S&P 500 really pulls away from the VS10 group, and we'll explore kind of by how much in just a moment. But not only that, the VS1 group suddenly shoots from, let's say, 125 all the way to 300, over doubles in the space of just a few months. You can see again that the VS1 line crosses the VS10 line, because we saw that before. I noticed it and I nicknamed it the X of Doom. You can see what happened right after that. The VS1 was the first of the groups to really collapse in price. The S&P 500 kind of flattened out for a while, but then started to fall, and the VS10 group really took off from there. Because this was such a long period, we're looking at about 7 years worth of data here. So let's explore a little bit about what the relative performance during this time was. So there were, all in all, just over 2 years, 29 months of material underperformance for the VS10 portfolio versus the S&P 500. This was from about June of 1998 through October of 2000. The average underperformance during this time, this is the big hump that you see later in this graph. Basically, the way this graph is set up is that when the blue line is above the green axis, this is the S&P 500 outperforming the VS10. So you can see kind of that long period at first where we've got almost equal performance. This is where the S&P 500 pulls away, and this is what happens afterwards, where the VS10 starts outperforming. So during just this period right here, the average underperformance was about 15%. The maximum underperformance was 27%. That's here at this very highest point. Now it's telling that the VS10 group outperformed by 28% or more starting in May 2001. So you can see that the switchover from S&P outperformance to massive S&P underperformance happened very quickly in the space of just a few months. So after seeing this, I felt more comfortable. This was the longest period of abnormal performance, and the VS10 over this time, while it wasn't always the best returning, in the end it seemed to be the best strategy. I spent a lot of time looking at the 90s and less time looking at the age of easy money in the 2000s, simply because this age only showed a very weak degree of abnormal relative performance. Notice again that we've got the X of Doom here. This is right in kind of late 2007. And of course, after the X of Doom, we can see Doom. The VS1 performed very badly right out of the gate. VS10 kind of kept its value longer, but then finally at the Lehman shock started to fall as well. Now, the first thing that I was happy to see was that VS10's fall was not as great as either of the S&P 500 or the VS1 group. But what I was especially happy to see was the performance out of the trough. The VS10 just pulled away from the other groups of stocks. Looking at this data, I felt much more comfortable in saying that the VS10 was actually screening on stocks that seemed to be increasing in value at a better rate over time, no matter where we started measuring its performance. With that thought, I figured that it would be a very nice tool to use this value score to show how we can screen for stocks in a report. And this is the birth of the YCharts 10% sector report. Let's talk first about construction of the report. The 10% report is always published a few days after the start of the month, with the data as of the first of the month, or the last trading day of the previous month. It's designed to show sectors and industries with the most bullish and bearish investment opportunities. We'll talk more about this in a minute. The last thing that's important to realize is it uses Morningstar's sector classifications, which are a little bit different from the GICS classifications published by the S&P 500. Let's talk now about the layout of the report. So the first page, you'll see a table that has all of the sectors. Morningstar has 11 sectors in its universe. Has all of the sectors and the aggregate market cap for that sector, then the number of companies in each sector, and then the number of VS10 companies, the number of VS1 companies, and then what I call the bull-bear score. And this is just showing the relative percentage of VS10 stocks versus VS1 stocks, normalized by the number of stocks within the sector itself. So a higher bull-bear score, let's say 40%, would mean that there are a lot more bullish opportunities within that sector than in a sector that had a score of, let's say, negative 40%. So down below the table, you can see that there's a heat map. And that heat map is set up so that the market capitalization, the aggregate size of the market cap for each of these sectors is the size of the boxes. The color is representative of the bull-bear score. Each report takes the most bullish sector and then splits that out into the second page, where that sector is broken into its industries. And then we do the same thing for each of the industries within that sector, assigning them a bull-bear score and taking a look at their relative market capitalization size. Now, the details behind the bull-bear score and the way that charts are set up is in the methodology document at the end of the 10% sector reports. So please take a look there too. Now, if we've got bullish opportunities here on the second page, we should probably also have some bearish ones on the next page. Indeed, we have the top bearish opportunities set up in exactly the same way as we set up the rest of the report. Now, on the last page, we show a few notable VS10 stocks and a few notable VS1 stocks. This is just a list of stocks that you may have heard of or may be in your portfolio that may be over or undervalued according to our score. Now, the important thing to remember about this report is that it's designed for screening. The report, as you've seen, is arranged by the number of opportunities per sector and industry, not by market capitalization. Because of this, it's meant to answer the question, where are the most investment opportunities concentrated, not where are the largest cap opportunities concentrated. Well, if it's designed for screening, what is it not designed for? It's not designed as a prediction of which stocks will go up. It's designed as a screen. The value score metric is describing performance in aggregate, not at a specific stock level. In order to figure out whether a specific stock is a good idea or not, you have to do more work on it, and this was actually the birth of our 1% focus reports, where we take a look at one specific company that comes up in one of these screens. Well, the 10% sector report is also not a guide to ETF investing. Most of the really popular ETFs are market cap weighted. This report is not market cap weighted, but we're taking a look at an ETF tilt report and developing that right now and looking forward to publishing the first one soon. The last thing is it's not a measure of market valuation. We're comparing every company in our universe against every other company in the universe. And so it's talking about the relative valuation of those companies, not of the valuation of the market as a whole. Each 10% sector report has a lot more information about the methodology that we've used. It has the results of this backtesting data. Please download one of these reports and take a look at that section for yourself. Thanks for viewing today. Stop by YCharts.com and follow that URL to find more about our Platinum Professional product, or feel free to drop a line to sales@YCharts.com.